Welcome to Deep Dive, brought to you by Talk Tickers. We cut through the noise of earnings calls.
That's right.
And today, we're diving straight into GE Aerospace's Q2 2025 earnings call. Our mission, like always, is to pull out those critical insights, the stuff you really need to know from this aerospace giant's latest update.
And what an update it was. GE Aerospace really delivered a strong second quarter.
Strong is maybe an understatement.
Yeah, I'd say so. Improvement across, well, pretty much all the key metrics. You can see the confidence, too. Management raised the full year 2025 guidance right across the board.
Okay, that is a powerful statement.
Yeah.
So for someone listening, what are the key numbers that really paint this picture of strength? What's the story here?
Okay, well, the scale itself is pretty compelling. Orders, for instance, jumped 27% year over year.
27%.
Yeah. And total revenue, it actually broke past $10 billion, climbed 23% overall. And if you break that down, their commercial engines and services, CDS, that was up a huge 30%. Defense and propulsion, DPT, also solid, up 7%. But the thing is, it's not just the top line, it's how efficiently they're making money.
Right, efficiency. So how did that translate down to the bottom line, profitability?
Profit hit $2.3 billion. That's a 23% increase.
Okay.
And margins reach a really healthy 23%. Then you look at earnings per share, EPS, that came in at $1.66, a 38% jump.
38%. So that's not just revenue growth driving it.
No, exactly. It's, strong profit growth, yes, but also helped by favorable tax rate, lower interest expense. Oh, and a reduced share count, too. They're pulling multiple levers here, growing profitably and returning value.
And the cash flow often tells a deeper story, right? Almost like a company's superpower.
You got it. Free cash flow nearly doubled year over year, reached $2.1 billion.
Doubled. That's significant, wouldn't you say? That's the fuel for everything else, investments, returns.
Precisely. It gives them huge flexibility. And this isn't just, a flash in the pan. It's really rooted in their foundational strengths, their core mission. That cash flow lets them lean into those strengths.
Interesting you mentioned the mission. Invent the future of flight, lift people up and bring them home safely. It sounds good, but how does that actually become a tangible advantage financially?
Well, it's more than just words on a page.
Right.
Think about it. Nearly 1 million people flying with their tech at any given moment.
That's staggering.
It is. And that carries immense responsibility. This focus on safety and reliability, it builds trust. Huge value in that. Like, they were the first manufacturer, the very first, to get their safety management system, their SMS, accepted by the FAA.
Okay.
And they did it a full decade before it was even required.
A decade early. That really suggests a deep safety culture, doesn't it? Not just ticking boxes.
Exactly. It points to ingrained risk mitigation, stability, brand trust. And they're not static either. They're using things like AI-enabled tools now, improving inspection accuracy, consistency, very forward-looking.
Right. So that safety culture, the tech, what else underpins this performance?
Well, you can't ignore the backlog. It's massive, a roughly $175 billion.
$175 billion.
Yeah. That number gives incredible long-term visibility, predictable revenue streams way out into the future. It's why you hear them called an exceptional franchise, leader in propulsion, services, systems, and super resilient because, get this, 70% of their total revenue. It comes from recurring services.
70%. That's the anchor, isn't it? Makes them less vulnerable to sales cycles.
Absolutely. It's a powerful, sticky engine for stability.
Okay, let's talk about those engines then. Commercial engines and services, CES, that's the big driver, powering 3 out of every 4 commercial flights. I mean, it's almost impossible not to fly on their tech.
It's unmatched scale, truly. And within CES, the narrow body side is still incredibly strong, especially the CFM56 fleet.
The workhorse engine.
Exactly. Roughly 40% of those engines haven't even had their first big shop visit yet.
Still. Wow.
Yeah, and operators plan to keep them flying well into the 2030s, fewer retirements than expected. So they're now seeing a peak in CFM 56 shop visits coming around 2027. They're expecting something like 600 additional visits through 2028 compared to what they thought before.
That's a lot of extra high margin work lined up.
Huge aftermarket revenue for years. Now the LAT program, the newer one, that's hitting its stride too, on track to break even this year overall.
Okay.
And the actual engines, the original equipment, or OE, should break even next year.
So what's really driving that LE profitability path, especially on the services side? Anything surprising there?
Yeah, a few key things, actually. First, they're getting smarter about using their MRO shops, maintenance, repair, overhaul. As LEUP visits ramp up, they leverage those fixed investments better, brings down the cost per visit.
Makes sense. Better utilization.
Second, pricing discipline on the new service contracts. Takes time to flow through, but it's setting up future profit. Third, the aftermarket channel itself is growing. They see external shops doing maybe 30% of visits by 2030, which drives spare parts sales.
Right. And finally, and this is really important, huge investment in repair technologies. They want to more than double LAP-specific repairs by 2028.
Double the repairs.
Yeah. They've already developed over 200 new repairs just this year so far. Why? Because repairs cost way less than the new parts. Better economics, faster turnaround, win-win.
And it's not just cost, right? Performance matters. Durability.
Absolutely. The LAP-1A durability kit, fully in production now, and it's getting CFM 56 level performance, improving time on wing more than twofold.
That's a massive difference for airlines. Huge operational impact.
Definitely. And look at the GE9X for the big jets, famously the most tested engine ever. They're prepping it for launch with durability upgrades learned from all that testing, especially dust ingestion. It shows that long-term reliability focus.
Okay, and what about the wide-body side generally? The GE90.
Still strong demand there too,
Yes.
especially for freighters, which is actually extending the GE90's service life. And here's the kicker. A wide-body shop visit can bring in more than twice the revenue of a narrow-body one.
Twice the revenue.
That's
Okay.
right.
Yeah. And about 70% of the GE90 fleet still hasn't had its second shop visit.
So a huge wave of high-value work still to come there too.
Immense future potential in that high-margin segment.
So commercial is obviously firing on all cylinders, but they're not a one-trick pony. Let's shift gears to defense and propulsion technologies, DPT. How's that side looking?
Also a good story. DPT powers 2/3 of all U.S. military combat and helicopter fleets. That's a solid base.
A very solid base.
And they're benefiting from global trends right now, modernization, localization efforts. You see the U.S. reconciliation package putting over $1 billion into sixth-gen aircraft programs like FAXX.
Yeah.
The Navy's talking openly about needing a sixth-gen fighter.
So clear demand signals for the future there, strategic alignment.
Definitely. It signals a long runway for growth driven by, national priority.
And technologically, are they keeping pace?
Oh, yeah. Key advancements, like the XA100 adaptive cycle engine, that's now moving to the next iteration, the XA102. Plus, international stuff, like Avio Aero partnering on the Global Combat Air Program, GCAP. And work on propulsion for drones with Kratos. They're positioning for what's next in defense, globally.
Got it. So underpinning all this growth, commercial and defense, you mentioned their flight deck operating model. Sounds kind of corporate speaky, but is it actually delivering?
It does sound a bit like that, yeah. But it seems to be more than just a buzzword. It's their systematic way of turning strategy into, actual results.
Okay, give me an example. Something concrete that shows it's working.
Sure. At their MRO site in Selma, Brazil handles 1/4 of their global CFM 56 fan module volume. They cut lead times by 30%.
30% reduction. That's significant throughput improvement.
Huge. Directly impacts customers. And those AI inspection tools we talked about, cutting blade inspection time by roughly half.
Okay, so real measurable gains.
Exactly. Faster, more reliable service.
So with all this demand, what about capacity? And the supply chain, always the big question these days.
Right. They're planning to grow capacity, internal and external, by about 40% by the end of the decade.
40% expansion. Wow.
Yeah, backing it with over $1 billion in MRO and component repair facility investments. They even added a site in Poland, ZOS, to the network, inducted its first LAP engine this year.
And the supply chain side? Still bumpy.
They reported sequential improvement in material inputs and said over 95% delivery adherence from critical suppliers. That's apparently up almost twofold from early last year. Huge factor in the strong Q2 output. Inflation's still there, yes, but they reckon pricing actions and just getting parts more predictably will offset it.
Okay, so let's pull these threads together. Strong Q2, solid foundations, the operational improvements. What's the big picture look like for the long term? The outlook, capital allocation. What should listeners take away?
Well, their raised 2028 outlook is pretty striking. They're targeting around $11.5 billion in operating profit.
$11.5 billion.
Yep, with margins over 21%, and free cash flow of at least $8.5 billion.
So that's substantial growth from the current guidance.
It is over $3 billion more profit compared to the updated 25 guide. And driven mostly by commercial services, they see that translating into adjusted EPS around $8.40. It's a very clear growth story they're telling.
And how are they planning to use all that profit and cash?
The principles seem clear. Invest in the business first, absolutely. But then a strong bias towards returning cash to shareholders.
And they back that up.
They did. They increased the plan, now aiming to return $24 billion in cash through 2026.
$24 billion. How does that break down?
Over $19 billion in buybacks, roughly $5 billion in dividends. That total plan is actually up 20% from what they talked about just last year.
That's a significant increase, shows real conviction.
Definitely a strong signal. So for you, the investor listening, what does it all mean? Well, this call really hammered home the resilience of GE Aerospace, especially that services business predictable revenue, even when the wider economy gets choppy.
And those investments in things like the L-APE durability kit, they're not just technical fixes, are they?
No, they're strategic. Meet customer needs, sure, but also boost long-term profit by cutting shop visits and letting them leverage those repair technologies they're developing.
Right, so the strong backlog, the clear guidance, the operational gains from flight deck, it paints a picture of a well-defined path, even with challenges like supply chain and new engine ramp-ups like GE9X.
Exactly. They seem focused on navigating those headwinds while setting up for future success. And they keep investing in the next thing, the CFM RISE program's open fan adaptive military engines. It's about staying ahead, maintaining that competitive edge for the long haul, learning from past engines, improving durability, keeping performance high.
Okay, which brings us nicely to our This Is Not Financial Advice segment.
Ah, yes, the fun part.
Now, remember everyone, what we share here on the Deep Dive is strictly for informational purposes. It is absolutely not financial advice. Always do your own thorough research, or better yet, talk to a qualified financial advisor before making any investment decisions.
Okay. Couldn't stress that enough. With that very important disclaimer firmly in place, here's an outrageous but plausible trade idea inspired by this call.
Okay, let's hear it.
Oh.
Outrageous but plausible.
Okay. Go long GE Aerospace and go short a smaller, maybe less advanced third-party MRO provider, specifically one that focuses on older legacy narrow-body engines.
Ooh, interesting pair trade. Long GE, short a smaller MRO. Who's the audacious thesis behind that one?
The thesis is basically this. GE Aerospace is getting really aggressive on the aftermarket. Remember that push to double LEP repairs by 2028?
Yeah.
Combine that with expanding their own MRO capacity, both in-house and with partners. Plus rolling out better durability kits for LA-APE and CFM56. Put it all together.
They're aiming to capture a bigger slice of that high-margin aftermarket pie themselves.
Exactly. They want to bring more work in-house or to their preferred partners. They have the scale, the tech, the proprietary data. This strategic push could seriously squeeze the margins and market share of those smaller, maybe less efficient MRO shops. The ones who don't have the capital or the deep insights to really compete head-to-head on the newest tech or the most advanced repairs.
So to bet on GE leveraging its integrated advantage to dominate the lucrative services game even more, squeezing out the independent competition.
That's the core idea. It's a battle for the aftermarket, like you said, and GE is bringing some serious firepower. Plausible, right? Even if a bit outrageous.
It's definitely a fascinating angle, a forward-looking take on the competitive dynamics. Okay, so to wrap things up then, GE Aerospace, really robust Q2, raised outlook for both 2025 and 2028.
Yep, strong performance.
Underpinned by that incredibly strong services business, real operational gains from their flight deck model, and continued strategic investment in the kind of aviation tech that will shape the future.
Absolutely. This deep dive should give you a really solid grasp of the key takeaways from their latest call, a shortcut to getting properly informed.
And once again, folks, please remember, everything discussed here is just for general knowledge and entertainment. It's not financial advice. Do your own homework, always.
Please do.
We really appreciate you joining us for this deep dive. We'd love to hear what you think, any questions you might have. Until next time.